Hi, this is Charlie Jewett, industry whistleblower, podcast host, and author. And what I'd like to do in this video is bring you some information on IN-Crease accounts or how to grow your money. Now, this particular video is part one of two parts. I was going to create one video, but it turned out that there's just so much content that it's going to be fairly long. Each of these videos maybe, 40 minutes, 60 minutes. I'm not quite sure how long it's going to be. But in this first part, I'm going to teach IN-Crease accounts, part one, which is how to grow yet to be taxed retirement accounts. Now, in the industry, we call this qualified plans, but I know some people may not know what that terminology is. And also, the Roth IRA is a qualified plan, but kind of handled kind of different than yet to be taxed accounts. So in part one, we're going to talk about IN-Crease accounts. Now remember, the retirement plan that never fails, and this is part of the retirement plan that never fails series. The retirement plan that never fails is where you take three types of money, or you take the money you've saved up, your nest egg, and you divide it into three types of money. Now, why do I say three types of money? Because most of the industry, the advisors get paid much better. They get paid more money, and they get paid monthly whether they work or not, to have you only use one type of money, which is putting your money into stocks, bonds, and mutual funds. So when you retire, many so-called advisors are going to tell you, well, just leave everything in your brokerage accounts, leave your IRAs, at some custodian somewhere, and they're going to manage it and try to make you 5, 6, 7, 8, 9%, and they're going to allow you to take an income off of those accounts. So that is very, very dangerous because of something called reverse dollar cost averaging. We don't know where the markets are going to go. You're just gambling. As your account gets smaller and smaller and smaller, if things don't go well, you'll start to punish yourself. Go back and look at the income training that I have on the same site here on YouTube. But the advisor who shared this with you wants you to understand before you meet or between meetings, wants you to understand that there are so many other options. Risk has been unnecessary and optional for 20 to 30 years. We don't only have stocks, bonds, and mutual funds in this world, and Americans are very addicted to that one tool. And it's not necessary for you to live in ignorance and not know about the other tools. The other tools are wonderful. You deserve to choose the ones that you really like. But people don't know what they don't know. So after this video, you're going to feel empowered. You're going to know so much more about your options. So let's jump into it. Imagine a world with no stocks. I mean, no stock market. There's no S&P 500. There's no Dow Jones. There's no, CNBC where we're watching things go up and down. There's no Trump run-ups, no quantitative easing. Just pretend for a moment that risking your money in stocks, bonds, and mutual funds didn't exist. Now, why do I want to do that? Is that realistic? Is it realistic to say stocks, bonds, and mutual funds don't exist? No, it's not realistic. But if you have ever been around somebody with a seeing disability, or somebody who's blind, or someone who's lost another sense, a blind person often has a much more acute sense of hearing, or what is available to them. They've learned to use it even better than you and I do. And that's what I want for you, is I want you to say, pretend the stock market did not exist. What would we do? Okay, now the first thing I'm going to do is show you something that is kind of true in the world of portfolio management, or building a portfolio. Typically a portfolio is built up, oops, that's a little small. Typically a portfolio is built up of different types of securities. So when the stock market, if you're using the stock market, it used to be you put your money maybe in cash. Some of the money is in cash, and try to grow it at 2 to 4%. But then some of the money would maybe have been put into bonds. They try to do more into bonds as you get older. Maybe that might make 4 to 6%. And this is sort of old school portfolio management, right? And then they try to have some home run money, maybe even make 8 to 10, but let me just be conservative and say 6 to 8, and this would be stocks or some type of securities. Today we have ETFs and mutual funds and REITs and all kinds of stuff, but just let me be very basic here in the beginning, please, so you can understand this. If you have some money in more conservative things like this, some money in bonds, or something that's making 4 to 6, it's kind of moderate, and then you have some aggressive stuff, they call that asset allocation, spreading the money around so it's not all in one thing. And there were decades that this worked really, really well. And then people would come along and say things like, okay, if you're 64, then you should have 64% of your money in bonds and the rest in stocks. Now, forget for a minute that that's the security guys saying that. It's the security onlys guys saying, well, take all the money in your life and only use the products that we offer, and as you get older, you should put more in the conservative product we offer, and you should put less in the aggressive product that we offer. Forget for a moment that they're ignoring every other tool on the planet, some of which are incredible for retirees. Just take this rule of thumb we used to have. Some people add 10 years to it. They say if you're 64, you add 10 and should have 74% of your money in bonds. It doesn't matter. What they're saying is, as you get older and have less time to recover from losses, you should have more in safe things and less in risky things. And back then, bonds were safer and stocks were more risky. But what are bonds doing today? Do bonds make 4 to 6% today safely and go the opposite direction of stocks? When stocks go down, do bonds go up? When stocks go up, do bonds go down? In 2008-2009 crash, in the crash of 2008-2009, we saw that kind of everything went one direction. And good advisors and money managers went, whoa, what's going on there? The other thing is, do today's bonds pay 4 to 6%? No, they don't. They're paying less than that. They're not paying enough to really even be that exciting. The other thing is, when do bonds do really well, or bond values? Bond values do really well when interest rates are dropping. The value of a bond has an inverse relationship to interest rates. Well, where are interest rates right now, and where are they most likely to head? It's 2017 when I'm recording this. Rates are starting to head up, and we need that. We haven't had increases in a long time. I think we just had our first one. So with bonds not paying what we need, not necessarily being, going the opposite direction of stocks, so not having that safety, and then the value not being that safe, bonds aren't able to do their job right now. If you put 64% of your money, if you're a 64-year-old, you put 64% of your money in bonds and the rest in stocks, it could all go one direction again. And by the way, some of you may have noticed this, the money in the bank's not really paying 2 to 4% cash. You can learn that from these trainings. You can go back and listen to the In-Case video or watch the In-Case video where I teach you how our clients make between 5 and 11% on their cash. Some years they make 0. Well, if you make 0, that's almost exactly what the banks are paying right now. And frankly, making 0 for a year or two and then turning around and making 5 one year and 8 the next year and 10 the next year, that makes you a lot more money than just letting it sit in cash. So go back and watch the In-Case video. Now, let's just do this. Let's do kind of what I mentioned about a blind person where their hearing might get better. Let's pretend there are no stocks, bonds, or mutual funds in the world. We just have the need to build a portfolio. How would we build a portfolio if we had no stocks, bonds, and mutual funds? Where would we get our 2 to 4% on our cash? Where would we get our 4 to 6% on our bonds? Well, I've taken hundreds of people through this exercise because I believe it to be an incredibly healthy exercise to walk yourself through to pretend that stocks, bonds, and mutual funds don't exist and say, what else would I do? Why do I think that? Because you learn tools that you did not even know existed. Oops, let me go a little bit bigger than that. So how do you make 2 to 4%? We do it all the time. We make 2 to 4% in MECs. What's a MEC? Modified endowment contract. Some people call it a GIC, guaranteed insurance contract. So a MEC is a single premium life insurance policy. You don't care about the death benefit. You're not buying it for life insurance. We're buying it for the terms. No penalties. You get your money back anytime you want. The first 11.5% of the S&P 500 growth goes to you in the most popular contract right now. First 11.5% goes to you, and the down years you never lose a penny. Has a 2.5% minimum at the recording of this training. So making up to 11.5% per year, and then in the down years you make nothing, but there's a 2.5% guarantee if you walk away. Our cash is easily making 2 to 4%. It's actually averaging 6.69, but let's just be super conservative. If you can get 2 to 4%, all right, that part of the portfolio is taken care of. We got our cash working for us. Where do we make 4 to 6% if bonds aren't doing their job anymore? Well, growth annuities, which I'll talk about today. So we've got growth annuities. Over here, they're making, I'll show you, the ones I'm going to show you are actually making a little bit more than this, but they just seem to be really high right now. So let's just call it 4 to 6%. So that middle part of the portfolio could be growth annuities. And then where do you go get, you're going to see this in the IN-Crease accounts part 2, where do we go get the big money? Where do we go get stock-like returns? How do we make 6, 7, 8, 9? Well, cash, value, life insurance. Nobody boo just yet. If you understand this tool and you don't let the popular pundits of the world who talk bad about it, if you understand this tool, you can go learn how to make 6 to 8% tax-free. It has to be built properly, and it's a zero-sum game. If somebody builds it improperly, it's going to be too expensive. You're not going to make any money. Your account's going to go down. You're going to lose money. If somebody builds it properly for you with minimum death benefit, minimum commissions, the right type of death benefit, whether that be level or increasing, the right insurance contract, blah, blah, blah. Take a look on this channel on YouTube. You can look at the 6 ways to improve your cash value life insurance, learn a little bit more. But these have a 30-year average of 8.2 tax-free before expenses. Those expenses should be about 1 to 1.5% when built properly. 8.2 minus 1.5% takes us to about 6.7% net returns, cash on cash, with no losses, and side benefits like death benefit and long-term care, which is awesome. So if the stock market did not exist, but we still needed to create a portfolio, we still needed to create something that would, whoops, it's got me on the letter here. We needed to create something that would give us these 3 categories or build a portfolio. We could do it this way, and more than 80% of our clients, maybe that's true for the advisor who gave you this, or maybe it's not, their percentages might be a little bit different, but as a group, more than 80% of our clients choose a portfolio that never goes down, no losses ever again for the rest of their life, maybe no fees, and they just choose not to have the stock market. Why? Why is that? Is that because these tools are better than the stock market or have more upside potential? It has nothing to do with that. It has to do with when you get to this certain phase in life where you're going to be, retiring, you can't afford losses anymore. And it just becomes convenient and comfortable to not ever have losses again. So let's jump into some of these tools and kind of let me show you how they work. One term you're going to need to fully understand, because what are the options for these yet to be, taxed retirement accounts? And this is pretty important, and that's why I broke this up into 2 trainings. The options that you have available to you are bank products. So you could do CDs, you could do money market. There are money market IRAs. So we're talking about yet to be taxed retirement accounts. This is like an employer account where you got a tax deduction on the front end for putting money in, or it was sucked out of your paycheck. You built it up in a 401k, or you built it up in a 457 or a 403b, or it's a lump sum payout from a pension, or it's an individual retirement account that you funded. This is money that is yet to be taxed. When you take it out, you have to pay taxes on it. Your options are bank products, number 1. What's another option that you have? Another option would be the market. You certainly can put money into the market. So this would be stocks, bonds, and mutual funds. And I'm not saying this is right or wrong. I'm just saying every tool has something it does well. Stocks, bonds, and mutual funds have some unique issues with the way they calculate your returns, the way the math works, and then also just the fact that you can, lose money and it may not grow. And the one that most people don't realize, so I'll spend the most of my time teaching this one today, is growth annuities with why is it angry at me? Annuities. There we go. No fees, no losses. And that's the one we'll take a look at here. So growth annuities, having your account never lose money ever again in all of the down years. You just keep steady. You just you have exactly the same money as you started the year with. No one's ever going to charge you a fee, so there's nothing coming out of it. So you have nobody taking money out of it, and there's no losses in down years, and you can get half of the upside of the S&P 500 or the first 11.5% of the market. I want to teach you some of this right now, how it works, and give you 3 examples of the products just so you understand what's out there for yourself. Okay, let's take a look here. One of the things you can do, I'm going to do it for you. I already have one pulled up, but one of the things you can do is put into Google, just put in indexed annuity graph. Indexed annuity graph, hit return. Probably more convenient to come up, go to the images, and you can just kind of pull up for yourself some of these pictures that I'm going to use right now. Some of these are going to be advertisements for some financial firm or whatever, and that's fine. Really, the content is what I want you to see. And so I've got one pulled up over here. I think American Equity probably did this one. They were one of the first to kind of show us these graphs, and they're pretty useful. So if you look way down the bottom, hopefully it shows up on the recording here. Way down the bottom, you can see this graph is comparing 1990 from 1998. Way down here. Oops, I don't have my pen yet. Let's see. Is it going to let me do this? Highlighter, no, pen, yes. Oh, maybe not. Maybe I just can't do it on a picture. That's fine. Way down here we have 1998 and all the way over to 2016. We don't know what 2017 is going to look like yet. But here we've got a comparison of the S&P 500, some sort of a minimum guaranteed contract value, which we won't pay as much attention to, and then this annual monthly average of an indexed annuity or a growth annuity. No fees, no losses. How does this work? When the market goes up, so the red line is the market, the S&P 500, when the market goes up, in this case it looks like it went up about 21%, the annuity, or kind of what I'm saying, is replacing bonds. Bonds aren't doing their job anymore, so what do we do for that safe money in the portfolio? How do we make our 4 to 6% or whatever safely if bonds aren't doing their job? They're not paying enough, they're not super safe right now, and they go inversely to interest rates, so that's kind of an issue. What do we do? Well, in this case, the annuity, you get none of the losses and some of the gains. That's an indexed annuity. None of the losses, some of the gains. So the market goes up 21% here, and we can see that the annuity went from 100,000 to 115, so it went up only about 115. And I don't know this annuity. I don't know if it has a cap or a participation rate or a spread. I don't know what the strategy is. I want you to understand the basics first. So we're not making as much on the up years as the stock market. So what can we say about the stock market? One of the strengths as a tool, because it's just a tool, it's not good or bad, one of its strengths is you get really high upside potential. It's exciting. You can make a bundle of money at one time. So for 2 years, the market went up, boom, right, 21%, then boom, something lower than that. We're from 100,000 to almost 136,000 or 137 in 2 years. That's exciting. That's one of the things the stock market does well. However, as a retiree or somebody who's conservative or needing to based on age or just your risk tolerance, somebody that wants to not take huge losses, there's a weakness to the stock market where, this is 2000 and 2001, the market crashes. You're down below where you started after 3 years, and then it crashes again. And man, oh man, if you're taking money out for income, this is why I don't do income in stocks, bonds, and mutual funds. If you're taking money out at the same time as it's crashing, reverse dollar cost averaging does some bad things to you. It is a bad way to go. That's why you can only take about 2.8% out of these portfolios, and that's not enough. But how does a growth annuity, how does an indexed annuity work in these down years? The market crashes big time, and you just hold steady. You just go flat. That's the contractual guarantee that hundreds of thousands of people have chosen to have with insurance companies who have done this for years. This is what insurance companies do. They mitigate risk, decide what they can give you, and they carry the risk for you. In the down years, you never lose a penny, and there's no fee, so you just go sideways. I don't know why this goes from 125.80 to 125.155. I don't know why that is. So I'm just going to assume it goes sideways because that's how most annuities work. No losses. Worst case scenario, zero is our hero. You get a call from the advisor who gave you this video, and they say at the end of the year, we didn't make any money because the index went down. Rather than losing money, rather than having less sheep than you started with, if you have 1,000 sheep and you lose 100 of them, they cannot make as many babies. They're going to say, none of the sheep died. You just have exactly the same amount of sheep. They just didn't have any babies. Is it exciting to not grow your money? No. We all want to grow our money every year for the rest of our lives. But it's way more exciting to have the exact same amount of money as you did at the beginning of the year when the market goes down and everybody else has lost money and has less. So we have up, up, sideways, sideways, up, 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 up. And if you can learn this, if you can just learn this, you will be so far ahead. The market tends to fall quickly. We have the whole 67-year history of the S&P 500 and how it moves. It usually falls 1 year at a time. This particular drop of 2 years in a row is only the second time that has happened since 1950. It happened in 73 and 74, and then it happened in 2001, 2002. Those are the only two times it happened in that 52-year period. And then obviously you can see it over here again, 2008. Normally though, it falls 1 year, but even if it falls 2 years, 2 negative years, and then 1, 2, 3, 4, 5 growth years. 1, 2 negative years, and then 1, 2, 3, 4, 5, 4 or 5 growth years, depending on what's going on there. I think there might be a fee being applied, because up here I'm actually seeing growth. So that's very normal for there to be a quick fall. There's kind of a gravity to the market, panic selling, people are trying to get out, and then the market climbs slowly for 4 or 5 years. Well, if you let your money go down, that hurts you, because we have 1, 2, 3, 4, 5, 6, 7 years before you even get back to the same amount of money you had. You just lost 7 years of compound interest. The most important thing in growing money is time. Here you lose 1, 2 years, and then 1, 2, 3, 4. There's 6 years of growing money that you lost. Add it to that 7. That's 13 years of nothing happening. What happens if you don't let your money go down, though, and you just have 0%, 0%, and then you have 5 years in a row where you make money? Look at this brown line. The brown line versus the red line says in a real time frame of 18 years, the last 18 years, what would have happened in an indexed annuity versus the market. Now you have to pick a good indexed annuity that has, upside potential and they share the profits with you and all that. But what would have happened without all the belly aching, without all the crying, without all the worrying, just slowly and steadily staircasing up, without all this roller coaster, you end up actually at a higher place than the market. I don't know where the research came from, but I was at a conference recently and they said indexed annuities have beat the market over the last 17 years. Well, I believe it, because none of the losses and some of the gains certainly beats all of the losses and all of the gains when you have a 13-year period where nothing happens. That's a hard way to go. No one is saying, your advisor is not saying to you, and I'm not saying to you, that the stock market isn't going to do well from when you retire until you die. No one is saying that. What we're saying is, let me see, where's my picture here? Where is that? Calculator, let's see. Oh, I know where it is. Right here. Nobody is saying that the stock market isn't going to do well. We are simply saying you don't know what it's going to do, so you probably shouldn't have 100% of your growth money, your IN-Crease account, in stocks and mutual funds, or even stocks, bonds, and mutual funds, with bonds not doing their job. So, what do we know of the stock market? What does the stock market do well for retirees? This pen is really not working. All right, who cares? What does the stock market do well? Stocks, bonds, and mutual funds. Do we know the rate of return? No. Do we know the account balance? No. At any time in the future, we don't know what it's going to be. Depends on market performance. Can you take an income safely and know that how long it's going to last or how much income you can take? Nope. When one person dies, the first spouse, do we know what's left for the other person? Nope. Second person dies, what's left for the kids? Nope. First incident of long-term care, how's this going to go? No. No. Tax rate? No. Stocks, bonds, and mutual funds, it does not make it right or wrong. We just don't know anything because people, please just embrace this. It is gambling. It's a form of gambling where we take risk. You put money at risk, buying into pieces of companies and things like that. We don't know how those companies are going to go. It might go up and it might go down. But with annuities and life insurance contracts built the same way, every single thing the retiree needs or wants can be guaranteed. It doesn't make stocks right or wrong. It just means as a tool, their strength is not protecting your assets or making sure that they grow, yada, yada, yada. The strength is they're fun, they're exciting, and they give you a statement every month where you can go, ooh, up or down, get all excited, have fear and greed, give you some good, endorphins and dopamine or whatever it is. We just don't know what's going to happen with them. So if you'd like some of the money in your life to never lose money again, nobody's charging you a fee at all, yet it's making 4 to 6%. Growth annuities are a great option. Let's take a look at an example of a growth annuity so you know kind of what I'm talking about, and you can see right on company paper what this might look like. Let's pick one that doesn't have super high returns, but just so you can see it. So I picked 3 companies. There's hundreds. I don't know if there's hundreds of companies. There's hundreds of products. Let's see here. So scroll down. When you look at an annuity illustration, so your advisor can give you these, they're going to show you guarantees. So if you look on the screen right here, it should say guaranteed annuity contract values. What is guaranteed in an annuity that says if the market goes down, you get no growth, but you don't lose any money? Well, what's guaranteed is that you have exactly the same money as you started with. There are no losses. Risk and losses have been optional for 20 to 30 years because of this tool, indexed annuities or indexed universal life insurance contracts. For qualified money like IRAs, 403bs, 401ks, you can't use life insurance without paying the taxes on it first, taking it out and putting it in. That's why I'm not going to talk about them on this training. In-Crease accounts number 2, I'll talk about non-IRA money where taxes have already been paid. But right inside the IRA, you can transfer money with no taxes due, custodian to custodian transfer. And this guaranteed is going to assume that the market never goes up again for the rest of your life. There is never a time where you make any money. Does that sound realistic for any index on the planet to never, ever go up again? No, it doesn't really sound very realistic. However, if you can build a financial plan that works out if there's no growth, then that's a good, safe plan. So you're seeing right in this area, 0% interest rate. We're assuming no growth. Of course, that's very unrealistic for indexes that bounce all over the place from one year to another because of emotions. But let's just pretend the worst thing in the world happens, there's no growth whatsoever. So this person is assumed to put in $259,000. Maybe there was a bonus, I'm not quite sure, but they start with $259,000. Therefore, what's the account going to be worth? Accumulation value in annuities means account value, by the way. So if you're used to looking at brokerage accounts, it's the same thing. So what somebody gets if you die, what's there if you make 10% next year, you're making 10% on that number. It's just an account. How would it grow if you make 0? You stay exactly the same because there are no fees. A bank is not going to charge you a fee to put money on deposit in their checking account or savings account, or when you buy a CD, they're not going to charge you a fee. If you buy a CD, they might have a prepayment penalty because they need to keep it for a while to make the money. Annuities are the same. But they're not going to charge a fee, of course, because they want your money, people. They want your money. People ask me all the time, why isn't there a fee? How's that even possible? Well, this is the whole industry. Insurance companies and banks have tons of money that they've borrowed from people. They just want it. They want to lend it out and make an arbitrage. They want to lend out, make more interest than they're charging you. So they're not going to charge you a fee. So literally your worst case scenario, if something super unrealistic happens in the world, like no growth to the index for 20 years or whatever, you will have exactly the same amount of money that you put in the first place. With bonds not doing their job, this becomes very important. What are we going to do with the safe growth part of your portfolio? Well, indexed annuities are one of those options. They're one of our favorite options because they make fairly decent returns. Let's come down and take a look at an example of what it might make in a better year, or in a more realistic scenario where there's some growth at least. If you look up top here, here's an example showing 3.39. Okay, that's conservative money for sort of the bottom of the portfolio. And this is pretty helpful. Here's 3 different times, the most recent 10 years, the best 10 years, and the lowest 10 years, 3.1 to 5.36. That's reasonable growth for what bonds used to do or what they were supposed to do, or for kind of the bottom portion of a portfolio, the cash and the middle safety part of it that we used to do with cash and bonds. this annuity would do a pretty good job for that one. No fees. So with no fees and pretty good growth, this thing would do a nice job. I mean, maybe the whole portfolio could take this and you just are happy making, 3 to 5.5% or whatever it is. But some annuities have a lot more upside potential or a better track record. And your advisor's job is really to look at every annuity in the country and see which ones are paying the most. What are the crediting strategies? Here's a really well-known company nationwide. I mean, for most of my career, 12 years, none of the name brand companies would ever show up at the top because they did so much advertising that their products just, they took the fees for the advertising, I guess, out of the products, and their products just weren't any good. But Nationwide's come into the market and been pretty competitive on the growth annuity side. What's their product look like? What are they offering? Well, if you take a look over here, their annuity, where it's just like the other one, where the market goes down, you don't lose a penny. The market goes up, you get some of it. There's no fees. Their growth annuity, the most recent 10 years, would have paid you 5.95 compounding, real compounding, not average rate of return, not the mathematical mean, but true compound annual growth rate of almost 6. The highest 10 years they could look at where you would have made the most in this product, almost 7. The lowest, the worst case, the worst 10 years at current crediting would have been almost 5. This also would do a really nice job inside of a portfolio. And let me go back to here, not the screencast, but here. Let's get rid of some of this. And let me go back to a little bit of drawing. Remember, if we're trying to build a portfolio like this, and down here, we're trying to make 2 to 4. Here we're trying to make 4 to 6. Here we're trying to make 6 to 8, let's say, just to grow money. Now, if you don't have any losses, if you never go backwards and you make these kinds of rates of return, you'll end up with even more money than you're used to seeing in your stock accounts where you're averaging these. If I have time, I'll talk about that at the end. But if you're looking to make those types of returns, then yeah, these annuities I'm showing you would do a great job for these pieces right here. They're going to be in that 2 to 6% range. And this particular one, looks nice, does a great job. Do annuities have penalties if you cancel early? 100%, yeah. You don't get this kind of protection from ever losing money again with no fees and great growth without something negative. All of us want that 12% a year guaranteed growth, completely liquid money. If we die, they give my family triple it with no taxes and they'll pay for my long term. Of course, we all want the perfect investment, but it doesn't exist. But surrender penalties and surrender fees are quite easy to get around. And inside of a true financial plan where you have in-case account money, income money, and then this is your IN-Crease money, very, very easy to get around surrender penalties or get access to money that you need. So committing to a time frame for having no losses at no fees and good growth, most people wouldn't want to cancel and walk away anyway. So this particular product right over here is making between 5 and 7% depending on the time frame. And then, now I've never seen one. I know this company really well. I have tons of clients myself with this company. But I've never seen an annuity that's paying this much. Even I'm in my 12th year, and when I opened this up to, I asked Case Design to create these for me, some growth annuities, so I could take a look at them. And I just have never seen one that had this kind of growth. So I wouldn't count on this, but if it's available, when your advisor's helping you make a purchase, if something like this is available, by all means, grab it. So let's look at guaranteed. In this annuity, exactly the same thing. The guaranteed rate, if the market makes nothing, so zero interest rate right here, you still have your $259,000. Now, I don't know why, but I noticed that it jumps for some reason out here. There must be another feature, because the word annuity basically means contract. You have a contract with an insurance company, so every contract is different. Folks, that's why you can't, with integrity, say something like, I hate annuities, and you should too. Or anything that can be done in an annuity can be, usually be done better somewhere else. That's why you can't have integrity and say anything like that, because every contract is different. Nobody can say, I hate contracts and you should too. Or anything that could be done with a contract could be done better. It's just silliness. It makes no sense at all. If somebody says something like that, there's some motivating reason, some monetary reason for them to try to get you to not use annuities. But this one right here, it must have some contractual guarantee that if you stick with them and the market hasn't made any money, they'll give you a little boost or something. Hey, that's nice. We'll take it. But with this particular one, I really just want you to see the growth because it's the way it's structured, they must just be sharing an awful lot of the up market with you. Let me come down here. This is kind of what I wanted to look at. So they're giving you a similar situation. Your advisor can give you, the appropriate illustrations for your state, your age, the top 3 companies for you. But over here you have the most recent 10 years, the highest or best 10-year scenario, and then the worst, the lowest 10-year scenario. And it's helpful to look at it this way. Look at these numbers. 8.49. Remember, no one's charging you a fee, and there's no losses. 9.22, 7.95. Now I'm seeing this geometric mean, which typically I would not like that. That's what I don't like about the way stock returns are measured, because it lies to you. But I've tested it. You can do the same thing. If you don't go below 0, if you never go below 0, never lose money, the geometric mean and real rate of return end up with almost exactly the same account balance every time. So a compounding 8.5 or 8.49, 9.2 or 8 on the lowest. Holy smokes, team. Are you kidding me? For safe growth with no fees, this can take care of, let's pick a different color just for giggles. Up here, the 6 to 8% that we need inside of a portfolio can be taken care of with an annuity like this. I know what you're thinking. Maybe you go, well, hold on, Charlie. Why would I even put money in the other 2 annuities if this one, why don't I just get the whole portfolio making 8 to 8.5? And I give you a big hearty yes. Yes, I'm teaching a concept that with annuities, you could have one that does this, one that does this, or one that does this, or you'll see in the next video on non-retirement accounts. Down here could be an insurance contract, a modified endowment contract. This one could be annuities. This one could be cash value life insurance. Boy, what a mess I'm making. But the reality is, if you have money sitting inside of IRAs, 401ks, 403bs, all of these are big, giant, safe insurance companies. If one went out of business, I'd expect all the other ones to go out of business too. We haven't had any of them go out of business in 200 and something years. So they're all just as safe in the way I've measured it with all the research I've done. The answer is, yeah, I probably wouldn't split it up. I'd put all the money into the contract that had the best crediting strategy. Maybe you're worried that they're going to, take the crediting strategy away. Maybe you're concerned about insurance companies going out of business for the first time in the world and the state guarantees and how much they're giving you. So you want to split up your money into different companies. All fine. All of that is absolutely fine. You just deserve to know and need to know the stock market is not the only game in town. You don't ever have to lose money again. That is a choice. Letting your account go backwards is a decision that you make and allow in your life. It is unnecessary, and you don't have to do it unless you want to. You can have every dollar in your life. You're not allowed to put every dollar in annuities. You can do up to about 75% of your net worth. But if you have enough money in your in-case accounts, you may be allowed to do this. Or maybe you didn't need to put money into annuities for your income. That's fine. But you can have up to about 75% of your net worth. But if you wanted every dollar in your life in strategies that are indexed, meaning when the market goes down, you never lose a penny, you can do that. You never have to lose money again. More than 80% of the people I work with, you can ask the advisor who shared this video with you, more than 80% of the people I work with choose to divorce the market and just not have it be a part of their lives, because at the stage of life that they're in, they just don't enjoy that the market doesn't do anything they want, and because they've seen the light. Their previous advisors were lying to them and hiding these tools from them, and then their current advisor, probably the person you're talking to now, came along and said, hold up, time out. There is more out there besides just risk with a side of fees. If we can make between 3, 4, all the way up to 8.5 or 9% safely without paying any fees to anybody and none of the emotional ups and downs that the market gives, boy, folks, that has its place in a portfolio. I am not saying annuities are the answer to everything. I'm saying if you're trying to create a safe portfolio and bonds are not doing their job, bonds are not safely making 4 to 6% as of 2017, I am saying that there's a way for you to still make that safely. And I hope that's helpful to you. Now, let's take a look at something else before I wrap this up. I want you to remember you are able to put money in the market when it's inside of IRAs and 401ks. Also remember that you're allowed to transfer the money from a 401k, 457, 403b, lump sum payout of a pension or an existing IRA. You can transfer that money into an annuity with no taxes due whatsoever. It's just going to be an IRA annuity. You are allowed to do that. There are no taxes due. If this will come up, it's looking strange, looking like it's not coming up. I don't know why. And I'll tell you what I'll do. Hey man, it's live training. Why not? Let's go here and open it up right here. That's fine. Wrong one. I want to show you. We are going to go here. What I want to show you right now is this maybe versus guarantee grid, not that one. I want to show you average rate of return. So you're allowed to put money in bank products. You're allowed to put money into annuities, which I just taught. So hopefully growth annuities, learning that is helpful for you. But you can also leave money in the market. There's nothing wrong with having IRA money in the market and growing. The bigger it gets, the bigger portion the IRS gets because they're sharing in it. So it's not my favorite money to grow. I like using IRA money to pay your income, to pay your bills. I like converting to Roth IRA and giving you tax-free income. Or if you want to get really crazy, I like using IRA money to pay for a mortgage that takes the money out of your house, and then that clean money goes and grows tax-free somewhere. And that's all part of, comprehensive planning when somebody really knows what they're doing. But just remember that your growth money, if you leave it in the stock market, it's not going to compound at 5, 6, 7, 8% necessarily. That average rate of return, and you can search for other videos that I've done on average rate of return, and this is thanks to Len Ranier from the Wealth and Wisdom Institute. There's an infinite number of different ways to make any percentage, and you end up with different money in your account. So for your advisor or a past advisor or whatever, for you to just think that you're going to make 6, 7, 8% compounding in stocks, bonds, and mutual funds is not really realistic. Every one of these on the screen averages 20%. If it goes up 20, down 20 over 2 years. Up 60, down 20. Up 100, down 60. Up 140, down 100%. We'll lose 100% of anything. We know your balance is 0. You're out of money, but you're averaging 20% over a 2-year period. Why is this the case? You just need to know this if you're going to choose to leave any money in the market. Why is this the case? Well, because money works like this. It's math. $100,000 goes down by 50%. You lose $50,000, right? I could have just multiplied by 0.5. You're down to $50,000. Well, let's say it goes up by 50%. So multiply that by 1.5. We are up to $75,000. So we all agree you went from $100,000 to $75,000. So you're down 25%. Over a 2-year period. But what are you averaging? Your joker broker, your advisor, if you had somebody in the past that was lying to you before the advisor gave you this video, if you had somebody in the past who was doing it this way, they say, well, you lost 50%, so negative 50 plus positive 50 equals 0, divided by 2 years, you're averaging 0%. So you're averaging 0%, but down 25%. What? Well, how else might that work? I don't know. Say you have $100,000. Oops, I did $1 million. $100,000, and you lose, you lose 33%. So let's multiply by 0.67. So you're down to $67,000. You lost 33%. All right. Then you gain 33% times 1.33. You're up to 89,110. So you're averaging 0 over that 2-year period, but you're actually down money. I'm seeing right now you can actually be averaging a positive return and losing money. $100,000 times 0.5, so you lose 50%. All right, then you gain, multiply that by 1.65. You gain 65%. Well, you're up to 82.5. You're still down $17,500, but what's your average? What are you averaging if you have negative 50 the first year, plus 65 divided by 2. Oh my goodness, Praise the Lord. We're averaging 7.5% a year because the stock market over a 210-year period averages 7.1 or 7.2 or whatever it is. Now, I'm exaggerating these numbers. The market typically doesn't go down 50 and then up 65%. I've actually showed you it's worse than that. It goes down, 27 to 40. The average is 27, by the way. If you look at all the bear markets since 1950 till now, the average drop is 27%. So, get ready for something coming. It's April 2017. We're 101 months into a bull market when the average is only 49 months. So we're way overdue. If the average drop is 27%, who knows what the next drop is going to be? But I'm telling you, the market doesn't really go down 50 and up 65. It goes down 30 or 40 and then takes 4, 5, 6 years to go up. But even if it did, even if it went down 50 and up 65, you're averaging 7.5 a year and losing money, going from 100 grand to 82,500. Whether this happens exaggeratively, like I'm using to teach this concept, this math is hurting you, period. You think you're making 6, 7, 8, 9, and you're paying somebody 1, 2% a year to put your money at risk for you to earn you an average rate of return, but it's not actually growing your account. People, I know your accounts have gone up from 2008 to 2017. No reason to talk about that. Everybody's accounts have. The market crashed, went to ridiculous lows. There's been quantitative easing, the Trump run-up. There's been a bull market to, an incredible bull market. That's fine. That does not mean that it's safe to put money in stocks for the next 30 or 40 years as you go into 30 or 40 years of unemployment, which is what retirement is. Okay? So let's start wrapping this thing up. I know it's a long training, but listen, you've got to put the time in because no one else is going to do it. Let me ask you a question. At your age, now I'm used to talking to retirees, so I'm going to assume you're pre-retirement in your 50s or you're 60 or 70 or 80, whatever age you are, doesn't matter. At your age, do you think you should have 100% of every dollar you have in stocks? Even if it's you set up an IN-Crease account and an income account. So you bought your annuities, you created your pensions, you purchased your pension paychecks, you got money sitting inside a modified endowment contract where our clients made 5 to 11% last year, but when the market goes down, you just make zero. There's no losses. They're not taking the fees out of your money or out of the money you can have if you walk away. Should you have 100% of your growth money in just one tool that has lots of upside and lots of downside? Well, I've asked hundreds of people, maybe thousands. Most people say no. Okay, what's the other place going to be? That's how you make this decision. What is the other place going to be? Are you going to put it in the bank, just inside your IRAs? Or are you going to put it into a money market, let's say, and make nothing? Probably not. Are you going to put it into bonds and cross your fingers that when interest rates creep up, your bonds don't lose value? Or try to hold them to term or just hope that they pay more? Maybe bonds can fill the role that cash used to fill. You try to make 1, 2, or 3% on them so they can be that cash piece. But the middle piece, the safe part of your portfolio, the safe growth that you need where you're not going to lose the money again, it's the foundation of the portfolio. Where are you going to put that today? I'm not telling you that annuities are the sexiest investment on the planet. I'm not even telling you that they have everything I like. I'm telling you we choose financial products, you choose a financial plan by taking a bunch of products that all have something wrong with them. They all have something you don't like, and you put them in the plan to do a certain job. Screwdrivers have things they don't do well. Hammers have things they don't do well. Wrenches have things they do not do well. I carried all of them in my tool belt as an electrician because they all had something that they do well. And that is how you buy these tools. What do growth annuities do well? They will give you 4 to 6% with no fees, no losses, which, if you remember, has beat the stock market over the last 17 years. Not sure why that got so big. There we go. It's beat the stock market over the last 17 years. Is this right for you? Well, talk to your advisor. Talk to the advisor that gave you this video. You have to understand surrender penalties, how to use bonuses to pay for the penalties so you can get a lot of your money out. The 7 to 10% free withdrawal is enough for anybody. Trust me, if you've set up your IN-Crease accounts properly and you can take 10% of all the money you put into the income accounts and you have another 7 to 10% to take from here, totally fine with liquidity if you're using mortgage planning techniques. Now you're really fine with liquidity, so penalties are not an issue, but talk to your advisor, talk to the advisor that gave you the video about what annuities in your state would work. But some of your portfolio, in my opinion, where we're at in 2017, the way the market really moves, and the age of people who are pre-retirement or are retirees, some of the money, you should not be paying someone a fee to go gambling for you to get average rates of return where the math lies. Some of that money, because bonds don't do their job right now, should be the safe portion of your portfolio that's giving you 2 to 4 to 6. We looked at an annuity that's almost up to 9, just giving you safe, compound, real rate of return growth with no fees. Charlie Jewett, out. I hope that helps you.